Where should you invest in 2026? And why are the world's most powerful financial institutions warning that the global economy is entering a new and dangerous phase? One sentence explains everything. The global economy is at a turning point, entering a new era of rising uncertainty and unpredictability. That statement came from Agustín Carstens, the general manager of the Bank for International Settlements, the institution that sits behind central banks themselves. When someone at that level speaks, markets listen. Investors are entering 2026 after one of the most extraordinary periods in modern market history. Currency volatility, geopolitical shocks, war-driven energy risks, and the return of inflation have reshaped the investment landscape. This is not a normal cycle, it is a regime change. So the real question is no longer how much money can be made, but how capital can be protected and positioned for what comes next. Let's start with gold. In 2025, gold experienced its strongest rally since 1979. Prices opened the year around $2,000 to $2,100 per ounce and surged to around $4,550 by December. That represents a gain of more than 100% in a single year. This move was not driven by retail speculation. It reflects a structural shift in how gold is viewed globally. Central banks are no longer treating gold as a hedge. They are treating it as a strategic asset and monetary anchor. Major banks are aligned in their outlook. JPMorgan Chase expects gold to approach $5,000 by late 2026. Goldman Sachs sees prices near $4,900. Bank of America targets $5,000. UBS forecasts $4,500 by mid-2026. Morgan Stanley expects around $4,800. Taken together, the average expectation is just under $4,850 by the end of 2026. Gold is no longer about fear, it is about trust and the erosion of it. Silver tells a different story. Silver surged dramatically in 2025, rising more than 150% and pushing above $77 per ounce. Industrial demand from solar energy, electric vehicles, data centers, and military technology played a major role. But silver carries a warning label. It behaves like a leveraged bet on economic growth. When growth slows or recessions hit, silver tends to fall faster and harder than gold. That makes it attractive for traders and medium-term speculation, but less suitable for capital preservation. Oil, meanwhile, remains hostage to geopolitics. Any escalation in global conflict can push prices higher overnight, but long-term demand is constrained by the global energy transition. Oil remains a tactical trade, not a strategic store of value. Stocks enter 2026 from a position of strength, but also vulnerability. In 2025, US markets posted solid gains, with the Nasdaq up more than 20% and the S&P 500 up over 16%. The problem is valuation. Historically, the S&P 500 trades at a price-to-earnings ratio of 15 to 16. In 2025, it traded between 22 and 24. That represents a premium of roughly 50% above historical norms. High valuations do not cause crashes on their own, but they make markets fragile. Any shock from interest rates, earnings, or geopolitics can trigger corrections. The key message for 2026 is simple. This is not the year to ask how much money can be made. It is the year to ask how capital can be protected. Even the International Monetary Fund is warning of unprecedented uncertainty, with risks tilted to the downside and the potential for unexpected economic shocks. Diversification matters, discipline matters, and humility matters. Markets change, cycles turn, certainty disappears. Stay safe.